but really watch for the unemployment rate, because if the unemployment rate goes up, defaults go up. People lose their income to service these mortgages, and that's the biggest problem. And you can see this is currently the Canada unemployment rate right now. We're hovering on the April numbers at 6.9. There is projection that we're going to get to the 8 over here, and that's where I think we're going to start having problems. And this chart here is looking at the 10-year, and you can see basically that we haven't had unemployment higher than 8% outside of the pandemic over here. So if we get to 8%, I think that's where we're going to have a problem. The pressure is on. The Bank of Canada is stuck between a rock and a rate cut. Inflation is slowing down, but the job market is cracking hard. 100,000 jobs are on the chopping block. Their next move on June 4th could make or break the economy in the rest of 2025. Stay tuned to find out more. Hi, my name is Zen. If you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. Now, TD has come out fairly bearish, and they've been predicting recession, and now they're predicting 100,000 jobs will be lost in the upcoming looming recession. And the reason why I'm bringing this up is a lot of people are getting head faked by the fact that we have core inflation going up, or the core CPI, and they're predicting that, hey, maybe rates won't come down. But what I'm going to tell you is that that's the wrong metric to be watching. The right metric that you should be watching is the unemployment rate. And I've talked about this in the past. If unemployment keeps going up, meaning more job losses, the Bank of Canada's mandate is to make sure sustain the economy and prevent it from collapsing as we go into recession with more job losses. So whatever the core inflation is not going to matter as much as the number of jobs that are being lost, i.e. the employment rate. And currently my base case is that we may get a rate cut in June, we may get a second one in July or September, but it's not going to affect the sentiment on the market. It's not going to make sales go up or down. It's not going to make prices go up or down, because there's so much uncertainty in the market right now that the only thing that the rate cut is doing for the real estate market is helping those who have not lost their job to hold on to their properties more, making their carry costs less. That's all it's going to do. And this is why I'm saying there's so many articles out there that are basically giving you a head fake on whether the Bank of Canada is going to cut in June or not. I suspect we're going to have to see multiple rate cuts before they instill a little bit more confidence in the real estate market to actually move past its current, call it quagmire right now, before we start seeing sales tick up. Key thing here I'm saying is sales tick up, not prices. So you can see over here in this article, they're saying, while core inflation has accelerated up to 3% despite a drop in headline CPI, and that's because that's what everyone's talking about. We had a CPI drop in April to 1.7 from 2.3 in March, and that's mainly due with the fact that the carbon tax came off. And this is why you have so many people reading different headlines saying that, hey, we may not get a rate cut. Whereas my base case right now is we're going to get rate cuts. And I agree with a lot of these economists that we're going to get one because the economy is bad. Unemployment is high. That's the key thing that we should be watching right now, not the headline inflation, because that changes all the time. And you can see over here that Desjardins economist is also calling for 3 rate cuts. Now, the reason why I'm saying the core inflation doesn't matter as much as unemployment is because we already had past precedent where the Bank of Canada has cut interest rates, being the overnight rate for the bank, when core CPI has gone up. So you can see this has been the rate cutting cycle in the last little bit that we've been seeing. So we were at 5 and now we've been zigzagging down over here. Now, if you look down here in this chart, you can see the blue bar over here, you can see that is the regular CPI, or what they call the headline CPI. The red bar over here is the core CPI. So you can basically see over here that this line is 0.5. We just got a 0.5 print. We've had a 0.5 print before, and this was in October of 2023. And you know what happened in October 2023? We got a rate cut. You see that? We also had a high core CPI in February, and we also got a rate cut in the March announcement as well. So this is what I'm saying. The unemployment rate is the more important metric to watch out for as opposed to the CPI numbers, because yes, core CPI can fluctuate on a month-to-month basis because there's a lot of different inputs. The main thing that's going to be supporting the entire economy is whether people lose jobs or not. And I've talked about this in the past before. Whether rates are high or low, in times of uncertainty right now, don't expect much real estate transaction activity, but really watch for the unemployment rate, because if the unemployment rate goes up, defaults go up. People lose their income to service these mortgages, and that's the biggest problem. And you can see this is currently the Canada unemployment rate right now. We're hovering on the April numbers at 6.9. There is projection that we're going to get to the 8 over here, And that's where I think we're going to start having problems. And this chart here is looking at the 10-year, and you can see basically that we haven't had unemployment higher than 8% outside of the pandemic over here. So if we get to 8%, I think that's where we're going to have a problem. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. Now, to make things worse, TD, the person who's predicting that there's 100,000 employees that are going to be laid off, basically started cutting 2% of its workforce, over 2,000 employees. That's a trickle effect. I've talked in the past before, there's been a lot of layoffs already, and TD just made another big one. You can see over here, the CRA cut a few hundred jobs as well. Now, this is a chart showing you the type of job losses that we've had in the past little bit. So if you're basically on the left side going this way, that indicates thousands of job losses in that sector. If you're on this side, it means that there's job gains. Here's the biggest problem. Your manufacturing, which are your automotive, is seeing a lot job losses. Retail, a lot of job losses. Business building, other support services or professional services, a lot of job losses. That is a big problem. And the reason why there's so much public administration job increases that offset some of these job loss numbers is because we just had a federal election where there's a lot of hiring for counting ballots and all the services for public administration in relation to the federal election. Now that it's over, expect a lot of these jobs to be gone. And you can see here, the public admin employment basically spiked like crazy over here because of the election. So if we were to revert back to call it 5,000 jobs, where we lose 25,000 of it, that's a really big increase in the unemployment rate depending on how they count the numbers. So the bottom line is the fact that we really got to watch the unemployment rate because that's ultimately what is going to be dictating whether we're going to start seeing more mortgage defaults, which will have a trickle effect on the prices and how many sales are actually going to be happening, how many new listings are going to be happening. Regardless of all the CPI mumbo jumbo talk, I think they're honestly all just a head fake. And this is why when I see articles like this where it says, hey, the mortgage rates being at 3% could be the magic number that reignites the housing market, I don't necessarily think that is true. We need confidence to come back in the market right now with all this uncertainty between job losses and all this trade war talk that hopefully will get ironed out in the near future. But I really don't see a mortgage rate of 3% maybe moving the needle that much more because a lot of people are reading headlines about condos right now and they're really afraid of investing. I think we're going to be in a decade where real estate investing isn't sexy anymore. And I'm actually going to split this up into investors and speculators. I think when the economics of it and the numbers make sense, the investors will come back, and we are fairly close to that. However, the speculators, because if they've been burned before or they're seeing a lot of these headlines of people basically getting burned, they're not going to enter the market and speculate, which was a big driving force in 2021. And to understand what 3% mortgage rates are going to do is that currently you could buy with a 4.1% mortgage rate on a variable side right now. That's what the variables are right now. So for you to go from 4.1% to 3%, that's a whole 1% drop from the Bank of Canada. And remember, I've been saying maybe we'll get 2. Some people are saying maybe we'll get 3. To get a 1% drop, you need to see 4 and the banks to keep their discounts, which may not actually even happen. But let's say it gets to the 4. Are these numbers going to make enough of a difference for the buyers in the market to kind of get off the fence? I'd say it make the difference for some, but it's not going to make the entire market come back. Because you can see when you go from 4.1% to 3% on, say, a $500,000 purchase, your mortgage goes from $1,900 to $1,600, which is a $250,000 price drop or about 13% reduction in your monthly carry cost, which is significant. But I don't think with so much uncertainty and job losses, it's going to make the market reignite, as the article said. And when you apply this to the $1 million purchase point, again, you just basically double up the dollar you save, but as a percentage, it's still 13%. Quick sidebar, if you're buying but not sure where to start or what's even a good deal, just hit the link in the description below, tell me what you're looking at, and I'll break it all down for you. No fluff, no BS, just real talk from a human and not just another chatbot. And another reason why I don't think the real estate markets come back is that when people want certainty, they want to go get it fixed. And what you're looking in front of me right now is the 5-year Canada bond, which directly affects the fixed rate. So loosely call it, you can say whatever the 5-year bond rate is plus 2% is what you're going to get for a fixed rate 5-year mortgage right now. So right now you could be getting a fixed rate mortgage in the high 4s. And we've now reverted back to a scenario where the variable is lower than the fixed, and that's normal. But when you want certainty, people go with the 5-year fix. So when you have such fluctuations and volatility between as low as say 2.5 going up to 2.8, which is a very, very volatile swing. It may not seem like it because it's a couple of basis points, but it is for the bond market. That's causing a lot of volatility in the 5-year fix. So when you have fixed rates swinging up and down so much, it removes even more certainty that people could get when they're trying to make $1 million decision. So as you can see, with so many things going on in the economy, even my base case of a rate cut coming in June may not change the direction up or down of the real estate market. Things maybe will stay flat because there's just too many things going on right now that's causing uncertainty. And this is why when we get that rate cut, I don't think or expect anything to change too much. And if you want to understand more about how rate cuts are not going to move the real estate market this year, make sure you check out this video that I made over here that goes into that in more detail. I'll see you in that video. Until next time, your move, your future. See ya!